Morning, everybody. Happy GrrCON to you. Happy Thursday. Apparently there's free beer pretty soon. This is the first time I've ever been to a conference that has free beer, so hopefully you'll take good advantage of that. This speaker that we have is Kelley Robinson. She's got a really cool title. I love this. Developer Evangelist. I want to be known as one of those. So she's going to talk about lots of fun acronyms as we've been trying to figure out for a little while here. So Kelley, thanks for being here.
Thank you for having me. Don't worry, you'll get way more enthused after I start talking about regulations. So that's what we're here for today. I figured nobody could get enough of GDPR, so I wanted to introduce another four-letter acronym, or just to spice up your mornings. So we're going to be talking about the second Payment Services Directive, which is European Payment Regulation, and specifically the language around strong customer authentication and what dynamic linking means. You doing okay on the audio? Okay, I will do that. I don't wander too far. Cool. So much like GDPR, a lot of this regulation is going to be applicable to companies outside of the EU. And so this is still going to affect your US companies. So even if you don't operate in Europe right now, a lot of this content is still going to be relevant. We're going to be talking about some authentication strategies that are relevant for both authorizing payments, but authorizing other sensitive actions as well. So my name is Kelley Robinson. I work at Twilio. How many people have heard of Twilio? A few of you. So we make communications APIs. So anytime you need to call your Uber driver, you're actually calling a Twilio number that then routes to your Uber driver. That appointment notification from your dentist is probably coming through a service like us. So I work specifically on Twilio's account security products. So Twilio acquired Authy about 5 years ago. So we have APIs for things like two-factor authentication and phone verification. And I specifically work as a developer evangelist on the developer experience side of that. So that includes maintaining things like our third-party helper libraries and language SDKs. I write a lot of sample code and sample projects to help developers implement our projects. And that also includes documentation and developer education. And so I do spend a decent amount of my time kind of advocating for authentication and identity best practices to developers that don't spend a lot of time thinking about security. So I have some experience being on the education side of educating developers on security best practices. So let's start by kind of talking about the size of this problem. Account takeover, so when a hacker gets access to your account and gets into your account and can do nefarious things with whatever that account has access to, this is a big problem. So it peaked at about $5 billion in 2012 there, dropped off in 2015 when chip and PIN was introduced in the US. This is US specific. But this has gone back up. And so in the last couple of years, it's spiked again. And in 2018, ATO fraud cost about $4 billion. And so that's kind of where, even though this is US specific data, this is a problem everywhere. Hackers are getting into accounts, as we know. And so this is something that we want to protect, that the session and the login is no longer quite enough to protect the end user from getting their payments or monetary actions that are sensitive and have to be caused, reparations and that kind of thing. And so that's a big part of the reason that we're trying to find more ways to secure these types of payments. And that's where the regulation comes in behind this. And so this is Payment Services Directive 2. There was a Payment Services Directive 1. So the original Payment Services Directive was back in 2007. So this was 12 years ago. And the goals behind this were a lot of unifying European payments. And so this was things like a single market for EU payments, making cross-border payments a lot easier. So if you've heard of companies like TransferWise, they do a really cool thing where they allow you to exchange money across currencies, and behind the scenes, they're actually doing currency exchanges or transactions between peers in the same currency and just kind of floating all of that money between a pool of users, so that if I want to give somebody euros, they're actually transacting that with other people that want to give somebody else euros. So they're trying to minimize the amount of like actual currency exchange that happens. They also wanted to fuel innovations in the payments and the finance industry, and that happened. So some of these companies like PaySafe and TransferWise and Klarna are examples of companies that were able to exist after the original Payment Services Directive came into effect in Europe in 2007. And so as you can imagine, traditional banks hate this, right? Because all of a sudden they have all these new competitors that are able to operate in ways that they previously couldn't because the regulations didn't allow them to. So with the right authorization now, companies can become a payment institution and do things like basically act as a bank and act as a mediator between payments and act as a mediator for e-commerce transactions and checkouts and login and that kind of thing. So like I said, traditional banks hated this, but European regulators decided that this was worth it to kind of democratize the finance industry in Europe. And that brings us to PSD2. So this was legislation that was introduced in 2015. And this updated a lot of the regulations on the original PSD. But mainly what it did is it started applying to talking a lot of language around card not present or online transactions. As you can imagine, there's a lot of different security considerations if you're putting credit card number into a form versus having the credit card physically with you. So you no longer have access to things like a chip. This is something that Europe was ahead of the curve with. They introduced chips before the US did. That was more widely accepted there. But online, they wanted to kind of get ahead of this and make sure that online transactions were being protected in the same way physical transactions were. And there's three main pillars to PSD2. So the first that is probably the thing that gets talked about the most is this whole idea of open APIs and open banking. And so the idea here is that a lot of banking institutions now have to open up all the data so that other people can access that. So things like transaction data. It can be anonymized, obviously, but you have to make it able for people to access their own data and do things and build companies around that. Again, traditional financial institutions hated this, but it has also opened up the way for people to add a lot of more interesting and useful tooling on top of the kind of old school banking that we had in Europe. I'm not going to be talking a ton about open banking today. The second pillar is about data encryption, and so that's just kind of how the data is stored and in transit and at rest. And the thing that we are going to be talking about today is this idea and enforcement around strong customer authentication, and so that's the third pillar that we're going to be getting into. So you're like, cool, Kelley, this is like legislation from 2015. Why are we still talking about this? Well, this is, somewhat dated legislation, but there's still looming deadlines. And so in 2019, this idea of strong customer authentication for purchases over $30 is a newly enforced regulation that banks are going to have to, and payment institutions are going to have to start doing. So if you do any business in Europe that involves payments, any payment over 30 euros all of a sudden has to have this idea of strong customer authentication, which is essentially multi-factor authentication for payments applied to the payment transaction. And this applies in three different cases. And so it's not just when the person is making the payment. That's option B there, initiates the electronic payment transaction. So that would be like a money transfer or payment. But it also applies when there is accesses payment account online. And so that would be like a login. That could be like accessing a statement page or something like that. And then the third way that when this applies is when it carries out any kind of risky action through a remote channel. And so this can be interpreted as something like adding a new payment recipient or changing the address on file or changing the credit card that you have stored on your account or something like that. So SCA applies in all of those cases. And what does this really mean? So much like the MFA that we might be familiar with for login, the authentication factors that are available you have to use two of the three types of factors, where a factor can either be something a knowledge factor, this is something like a password or a PIN, something that you have, a possession factor, this is something like a mobile phone or a physical key, or something that you are, an inherence factor. This is biometric data, Face ID, Touch ID, retina scans, that kind of thing. And this already happens in the world of physical payments. So I've mentioned this before. We have this idea of chip and PIN. That's something that you have, the actual card, and something that the 4 or 6 digit PIN that you're adding when you get a debit card transaction or check out at a mart with that you have the card physically available. But on top of that, they wanted to make this apply to online transactions. And so the legislation in this said that beginning September 14th of this year, non-compliant payments for SCA in the EU would be declined. And so this is like, wow, okay, we're getting towards the end of October. How many of you have like heard of this? One person, 1.5 people. Cool. So even people in Europe hadn't really heard of this. And so that deadline like came and they were like, oh shit, this is not actually going to happen. So in June, 3 months before the deadline of this, and like if you've worked with engineers, you know that things like this can't be built overnight. And it's unlikely that, especially when you're dealing with payment transactions, that it's going to be even built in 3 months. So in June of this year, the European Banking Authority issued this opinion, which is basically their guidance towards how to do this, that was like, oh crap, no one's actually prepared for this. Estimates were that if they were actually going to enforce this in September, it was going to cost the EU like $57 billion in lost transactions. And so this was going to be a huge deal, a lot of economic value lost. And only like 40% of companies were even remotely prepared for this in the EU, even back in the summer. And so in their opinion, they were like, okay, you can get a little bit more time. This was the official guidance, limited additional time back in June. And so the UK and Ireland, yes, this does still apply to the UK. Given whatever's happening with Brexit, they're still, this still applies to the UK. But the UK and Ireland said that they were going to take another 18 months to enforce this. Germany issued like they were also going to take a delay, a vague amount of time. Hungary said that they were going to take another 12 months. And that's kind of one of the interesting things about this legislation is that the EU and the European Banking Authority issues these opinions, but they're leaving it up to the individual countries to decide how to enforce the legislation. And so there's, even though the EU is kind of this like economic body for the region and the goals of this are largely around making sure that people have a lot of consistency, there is still some inconsistency with the enforcement side of this. But fascinatingly, last week, they issued another opinion that basically said, you guys have to enforce this by the end of 2020. And so they have basically like another year. They've got a little bit more than like 13 months to get this done. And hopefully most people will be ready in that time. So a lot of the stuff that I'm talking about, you might be hearing a lot more about in the next year still, because people are still working on doing this and making sure that this is something that they can be compliant with before this new deadline. And the delay is good because implementing strong customer authentication isn't quite as straightforward as adding MFA to payments. I mean, not that that's a straightforward problem either, but there are specific requirements like this idea of dynamic linking. And dynamic linking means that the authorization or the authentication has to be tied to the individual payment. And there are 4 requirements for this that we'll walk through, but this is an example of a dynamic linking transaction. It basically has to include the information in the message to the user. And so you see here that this has 2 important things. This has, the one-time password in this code or in this message, but it also has the company that you're paying to, the payee. In this case, Flourish and Blots is what is being authorized. You're paying to Gilderoy Lockhart, and it's 713 euros. So the goal here for the first requirement for dynamic linking is to ensure that the user is confident that they are authenticating the right transaction, so that the payer is made aware of the amount in the payment transaction and the payee. So that was what we saw on the last page. The goal for the next requirement, the authentication code generated, is specific to the amount of the payment transaction. You don't actually need to derive that code from the transaction details. You could do that, but you just need to maintain a reference. So you could basically have a UUID for every transaction or every authorization that's being issued, but it has to be unique to each payment transaction and the details of that transaction. The next requirement is that codes can be generated via multiple channels. So you can generate this via SMS. You could generate this via push authentication. You can generate this for the same payment through multiple channels, but as soon as you authorize or accept one of those channels, the other one is immediately invalid. So you can't just like kind of leave that out there to make, because that could open yourself up to risk and fraud. So multiple codes can be generated, but only one can be accepted. And finally, if anything about the transaction changes, you have to invalidate outstanding codes. And so you can't leave codes out there if the amount of the payment changes, if the person that you're paying to changes, that all has to be invalidated if any one of those details is updated. Cool. So there are a couple of exemptions for this. This isn't going to apply to every single payment, and this is where it starts to get tricky and where payment providers are starting to really build solutions around this to make sure that you don't have to go through all of this logic. So most importantly, anything under 30 euros is exempt. They're only worried about higher value transactions. Lower risk transactions are also exempt, and this is based on the payment service provider's fraud rates. And so, for example, if you have fraud rates under 0.01% as a payment service provider, so like the banking institution, you can exempt payments up to 500 euros, but that has to be specific to your payment institution. And so that's like for the payment institution, that doesn't matter for the end user. This is also exempt for recurring payments. So if you have things like, your magazine subscription or even like your electric bill, so it can either be fixed subscriptions or variable. So your electric bill might be different every month, but you have already authorized a recurring payment for that. You don't have to do this kind of like MFA on every transaction every month when they try to charge you again. And then this also exempts over the phone payments. There's a few other exemptions here, but these are kind of the ones that are most commonly asked about. So I kind of wanted to highlight those. Cool. So there's a few ways that you can implement a strong customer authentication. And the options here are largely similar to your options for MFA for login, with the exception of 3D Secure. Who's familiar with 3D Secure? So this is a payment it's verified by Visa, MasterCard Secure Code. They're like branded versions of this whole underlying payment security. And so these are things that right now you might not notice because they're kind of happening in the background. And this is where like the authorization is happening of your card. And so they're looking at like the risk of who you are and the payment that is going through. And this is how they try to determine whether or not this is like a fraudulent payment that's happening online. So this is MFA that's implemented by the credit card providers. And so if you're already using one of them, if you're already using 3D Secure, which your e-commerce platform might already be, they might already have a solution in place for this. There's a second version. Most people are still on version 1 of 3D Secure. The second version is coming out, is going to use a lot more information about device data for mobile payments and do risk analysis and adaptive auth. And so this will say, like, if we're not too concerned about this person, if they always get their Starbucks for $4 every morning, like we don't need to like actually, care about adding additional security to this, but that $500 payment for whatever we might want to make sure that we issue an additional check or add a token check or one-time password at that point. But unfortunately here, even though you might be able to bypass that, based on risk profiles of 3D Secure, you still have to go through the multi-factor authentication process for non-exempt strong customer authentication payments in Europe. You'll pay for this as part of your credit card processing fees, and I don't really know how much that costs, but I've seen it quoted anywhere between 20 and 50 cents a transaction. Another option that you have is kind of like building this yourself. You can do this with SMS, much like you could for 2FA for login. This ends up being the option that a lot of people use because it's so low friction, and it doesn't require that an end user download your app. So implementation was left up to the individual governments to interpret and enforce, like I said. So, this is officially compliant according to the European Banking Authority, but like I've heard that like French regulators might not be accepting SMS, and the reasons for that is SMS is insecure. And so this is something that like, even though it adds additional security, like SMS for 2FA is still better than no 2FA at all, like you have vulnerabilities with the SMS channel. There's a lot of ways that you're not actually sure that that is validating that possession factor of like the SIM card. The idea behind SMS as a second factor is that it's validating possession of the SIM card or maybe the device, but in reality, it doesn't really do that. Like people can log into the web portal to access their text messages often. SIM swapping, which is done through social engineering, basically convincing or bribing a Verizon agent to issue my SIM card to you. That's a thing that we see happening a lot, mostly for people that brag about how many Bitcoin they own on Twitter. But there's also vulnerabilities that are a little bit more technical. SS7 is a protocol, signaling system 7, that basically allows you to impersonate a carrier and get text messages forwarded to you if you successfully impersonate a carrier, because like telephony systems don't really have any security around this. There's no signing that's happening. There's no cryptography that's happening behind the scenes for this. So there's a lot of insecurities with SMS. And so different governments are trying to decide whether or not this is actually something that they want to accept. As of right now, it is officially accepted, but your mileage may vary. Transactional TOTP is something that we built at Authy. So this is cool because like soft tokens or TOTP that you would get with something like Google Authenticator, this does work offline. This is based on the RFC. That's an open standard, which is pretty cool. But then when you have this kind of open standard, it is more secure than SMS, but it is a proprietary solution. Another option that you have is push authentication. This is great because with push authentication, you might be familiar with this if you've ever used Duo. This has the add action context built in. It's really easy to include the dynamic linking. This is really low friction, which people like, but sometimes is like low friction, not enough security. Who knows? This is also a proprietary solution. You could build this into your own application, but it would require a little bit more dev work. And then I just want to finish up with a couple of comments on how this is going to affect U.S. companies. So this will apply to transactions where both the business and the end users and the cardholder's bank are located in the European Economic Area. And so if that's true to any of you, that, will apply. But, ROI for implementing this kind of thing might be worth it for mitigating the amount of account takeover fraud that you have on your businesses. And so you might want to do that analysis. If you already have ways to support something like a second factor for login, you might be able to add this to payments as well. There's a lot of skepticism whether open banking will ever come to the US, but Congress has talked about it, and so this is something that they're thinking about. And other countries are adding laws around this too. This kind of regulation has already been in India for over 5 years. Australia is introducing regulation for this in 2020, and Brazil and Singapore are talking about it right now. So this is going to apply in places other than just the EU. And so if you're doing business outside of the US, something that you want to keep your eye on. And then, like I mentioned before, you could use something like this for authorizations for more than just logins, taking advantage of the second factor, for sensitive actions like account changes, password resets, that kind of thing. If you already have a session involved, then you might be able to trust somebody to just authorize with the second factor. And as you're implementing this, you definitely want to keep the user experience in mind, because security is friction, and friction equals abandoned carts, right? If you're using this in an e-commerce situation, time is money, and you don't want to have users getting frustrated and leaving and abandoning their carts behind because they're waiting for a code to come through. So circumstances differ, offer additional options depending on what the circumstances may be, offer retries to customers to keep them happy, let them know what's happening so that they don't get too frustrated waiting for this to be approved. And it's funny because one of the original goals of Payment Services Directive was to speed up payments, but that was like cross-border payments in 2007. Our idea of fast payments was a lot different back in 2007 than it is in 2019. A couple of other things that you want to consider before we wrap up here. Does your payment service provider already offer a solution here? If you're using something like Shopify or Stripe under the hood, there's a good chance that they have already built this into consideration because they already have solutions for this for their customers. So you might not need to build this yourself, but you might want to check. If you're not dealing directly with consumers, so if you have any kind of like hospitality business, travel booking, that kind of thing, there are exemptions available for that you might want to look into. And then just like, do you process payments immediately? If you're doing a kind of a traditional e-commerce checkout, that might be a little bit easier to get that kind of multi-factor authentication code on the spot. But what if you're a rental car agency that needs to authorize a fuel charge for when the car is returned? Like, if you don't have that kind of upfront knowledge of how much you need to authorize, there's some additional considerations that you'll need to make. Here are a bunch of additional resources. I'm going to post these slides after this. Obviously, this is a ton of information, and while you are all now experts in European payment regulations, I expect that you might need to follow up on some of this. I hope that I've given you kind of an idea of what to expect with the regulation going forward. If you have any questions, I'm going to be around for the rest of the conference. Once again, my name is Kelley Robinson, and thank you for listening.